Today we'll finish most of 9. Okay? So what I want to do is get you to page 6. Now I am going to ask you a couple of questions on this, on the sales discounts or the cash discounts. So just to refresh your memory on this example, we're looking at accounting for sales discounts. 2 methods, although you may not have seen this formally in intro. The first method is the most likely amount, net versus gross method. The next method is the expected value method. So in this example, we have a company that sells hiking boots for $100. They sold 50, terms 210 net 30. 20 of them were paid on June 9th. It's within the discount period. The balance, the 30 units, were paid on June 29th, which is outside of the discount period. Now, we want to use the expected value method. And in the expected value method, we tell you that we believe that 40% will not take the discount. 40% will not take the discount, and we want to record the sale and the collections, assuming that 40% don't take the discount, that means 60 will, and we want to keep that information so that you'll see that the company sells 50 units at 100, $5,000 in total. Terms, the 210 net 30, discount on 5,000, 2% is 100. So the net amount was 49, which we established on Tuesday. Or per unit, it's going to be $98 a unit. Now, in using the expected value method, you have to create a probability weighted average so that, and I know you've seen this in business research methods or any type of statistics, so that if 40% don't take the discount, 60 will. Those that don't take the discount will pay you $5,000. Those that take the discount will pay you $49. When you multiply them by the probabilities, you get $29.40 and $2,000. And the weighted average probability, or the expected value, weighted average by probability gives you the expected value of $49.40, and the number per unit is $98.80. So that on average, weighted average, you expect $98.80 per unit. Now, questions on getting that? So we're going to give you one of the probabilities. It's got to hit 100, so you'll just plug the other. Any questions on the expected value? The problem, of course, is what happens when somebody pays you the full amount or pays you the net amount. And it's going to be the same situation that we had before. You can either have a sales discount if someone pays you less than $98.80, or sales discounts forfeited, which is income if someone pays you more than $98.80. So if someone pays you less than $98.80, it's going to be a sales discount, a negative account, like an expense for you. If someone pays you less than that amount, again, you've got that discount. If someone pays you more, you'd have income or sales discounts forfeit. So any questions on that before I move on to the next piece of this? All right, so now let's take the summary. And I decided to put this in more of a visual form. You got 20 units that were paid within the discount period. 30 units were paid after that discount. So I'm going to put this on the screen. Anyone have anything else on this? You want to need more time on that? All right. So, what I decided to do was kind of set this up. We're going to do some more on the screen. So, sold 50 units, 20 were paid within the discount period. That means you're going to wind up getting 98. 30 were paid after the discount period, you get the full amount of 100. So on the let's start with the 20 units. It's the June 9th. On June 9th, you got 20 units at $98. You collected $19.60. The expected value was $98.80. So you thought you were going to collect $19.76. You collected $19.60. So there is a $16 contra revenue. That is a negative revenue account. Sales minus sales discounts would give you net sales. So those net sales would be reduced by 16. On the other side of this, and I'll go back to this as well, 30 paid after the discount period, you collect the full amount. That's greater than $98.80. So you actually collect 3. You thought you were going to collect $29.64. That was the expected value. And therefore, you got $36 more than you thought, and that's known as the sales discounts forfeited, and that is interest income. So let's look at the calculations before we do the journal. Yeah.
The 98 for the 20 units is based on the 2% calculated from the total of the 20 units.
Yeah. So what would have happened here, again, let me bring that back on the screen. Each unit is going to be discounted by 2%. So that means it's at 98 or $98 per unit on a net basis. All right, so that means that the company collects either the net or the gross amount, but that has to be compared to the expected value. Any questions on the process as such? Make sure you have enough time to copy that. And then we're going to show you the entries in just a second. Now the entries are in the notes. You don't have to copy them down. I just want to use this as a guide. So let's see what happens. We'll leave this up on the screen. We'll make sure you're sort of caught up. So anyone need a little bit more time on this before I get the journal entries up? The journal entries are on page 6, the first one anyway. So now the first entry, let's not forget, when we took the expected value, was the debit accounts receivable. Credit sale, and that was at the expected value. Now, go here, let's take a look at the way this entry would appear. This is on June 9th. Cash comes in is the discounted amount of 98. The expected amount is in the accounts receivable from 1976, and the contra revenue is a sales discount. And that's the 60. Again, it's contra revenue. Negative or contra revenue. Now remember that this sales amount is at $98.80. remind you. Times the 50 units. So the receivables also 9880, 50, right? And this receivable again is at 9880. That's times the 20. So that's where the sales discount comes in. So any questions on the June 9th entry? Sophie, yes. I'm sorry, yes. 9880. Okay, so 9880 comes back from the expected value per unit. So when we did the expected value, total expected value is 4940 at 50 units. It's 9880. Any other questions? All right, so now, what about on this side of the transaction? On June 29th, you were paid after the discount period. So the cash collected is $3,000. The accounts receivable is the 30 units times the 9880. And that's going to be the 2964. And then the difference is income. It's interesting. So the account sales discounts forfeited is interest income, that's the 36. And those entries, as I said, are in the notes. Clear. Again, this is like interest income. All right, so that is the expected value number. That's the expected value. We're going to compare it to the most likely amount, approach in a minute, but any questions on this illustration? And all these entries are in the notes, so you can find them on pages 6 and 7. But I just wanted you to see it on the schedule. Sure. So then the only time you could receive more is if more than, well, this example, let's say some of those 20 units were paid after the discount. So it would actually fall to this side. So let's just say no one paid within the discount period. Then here you'd have 5,000 versus the 49 So you'd have $60 as interest income. Question? Any other questions? Anything else? Now let me show you where they are in the notes.
Professor,
Oh,
how often
sorry.
is this used, the expected value?
Hold on a second. Yeah, what was that?
How often is expected value used?
Expected value, I think the most likely amount is probably used more in practice.
Well, you just do like the 20 times 98 and then you end up at 4960 anyway.
So you're
That's this
saying,
adjustment you end up plus 20, correct? So you end up at 4960
yeah, for the whole amount,
for the whole amount.
4940. 4940 for the entire amount of 50. So, but I think your first question was in terms of practice, what's used most often. Right now, I think the most likely amount is used more than the expected value, but this is becoming, if you go back and look at the first couple of chapters with the conceptual framework, we looked at one of the concept statements we just mentioned, which was called the use of probabilities and present values in accounting. And we're finding out that's becoming more recommended. So more companies are using probability weighted distributions. And there's a new revenue recognition standard, which you'll find out in Intermediate 2, is extremely difficult. That's why we don't teach it in Intermediate 1. And believe it or not, everything's based on the expected value, sales revenue. So that this is just one example of that. Another example would be if you sold a product that would have, let's say, incentives. So let's say that if you paid, or if you had volume discounts, let's say you buy 100 units, but they say for the year if you bought 300, we would discount everything. You have to take a probability of how much you think, what's the likelihood that everyone or someone would take those discounts. Another example would be bonuses. So let's say that you had a business that was a call center. So lots of companies would use call centers for customer service or after hours. If those calls are answered within 3 minutes, you're selling the call center service, you would get a bonus of 20%. If the calls are answered within 2 minutes, you'd get a bonus of 30%. You have to do a probability distribution to determine what is the expected amount of your revenue, and that's what you book. Even if the contract says we're going to pay you $100,000 a year, you have to book $100,000 plus the expected bonus. The expected bonus, not the actual bonus. So when you get into Chapter 8 in Intermediate 2, you could have a contract that says $100,000, but that's not what you record. Revenue is now considered to be the amount expected to be earned, not the amount of the contract. And this is an example of it. So from now on, you're going to see expected values used, and this is the first introduction to that. But you'll see a lot more of that going on with sales revenue. Yeah.
So with the cash, with payments, you also have more percentages than this 210.
Oh, so, yeah, so, let me just make sure I understand the question. So you're saying, what if the terms of sale were 210, 315, net 30? Now you would have to have 3 levels of probability. That is, oh yeah, yeah, you could have, some credit terms could be, I think if you even look at what we said for one of the sample companies that we looked at, it could be 210, 115, whatever it may be, you might have 3 levels of probability.
Does that make it more accurate?
No, it just would reflect the actual terms of sale. And in the example I was giving with the bonuses, the bonus would be based on, that would be an actual contract. The contract would say, it's almost like in pro sports where you get incentives. So if you score X number of points during the year, if you win this award for best defensive player or something like that, this is what your salary would be. Right now, the NFL or whatever it is, Major League Baseball would book the sale at the contract amount, but under the new revenue recognition standard, you would have to book that contract at the expected amounts. What's the likelihood that this player will reach that level? And you could have multiple layers of a contract. And that's why I think that's why the FASB decided to change the revenue recognition standard, to make it more in line with actual contracts that we're experiencing, not only in sports, but even in business. So it's really incentive based. And there could be penalties too. So for example, if you have a call center, we use the example we had before, and if there is a wait time of more than 5 minutes, we're going to deduct that from your compensation. So that could also be part of the expected value.
Do you ever include probability for that?
That's a separate, that's after, we're going to do that now. So after, for example, after you get the sale, now the next step is collectability. So we'll see that in the next module. There are 3 levels. Number 1, how do you measure the sale? Secondly, how do you measure the expected amount or the amount that you expect to collect, and then what if you sell those receivables? So there are three steps in the receivable process. The first is valuation, or I should say measurement, initial measurement, valuation at the bad debt, and the third would be disposal. Good question. All right, so we will get, so this is the first step of what you're going to see in the revenue recognition standards coming up in 2. Great question, so I appreciate it. And if you have any more, before we go on. All right, so let me get back to, just to show you where everything is. So this is where the journal entries are. This would be page 6. So this is the amount for the case where you receive less than the expected amount. And on the next page, journal entry on page 7, is where you receive more than the expected amount. And then finally, you've got the comparison, so you can go back and line those numbers up. The only thing is, you're going to see, no matter what method you use, the net amount or the total amounts do not change. What changes, however, is the classification. So the only thing you have to be aware of is that we're always cautious to make sure that we classify revenue properly. So everything else here is operating income, except sales discounts forfeited is non-operating or other income. So just make a note of that. The only difference, the amounts would be the same on the bottom line, but they're going to appear differently on the financial statements. Now, if it's material in amount, it would make a big difference. So you can't go by the numbers we have here because they're very small. But just remember that everything except sales discounts forfeited represents operating income. Sales discounts forfeited is non-operating or like an interest income. All right, so does anyone have any other questions on the initial measurement of the accounts receivable with the sales discount for the cash? So now I want to ask you at least one of these questions. I'm going to do, during the review session, I'll give you the answers to the others. Let me ask you one. I want to make sure that let's do numbers 5 and 6 with you. So just hang on, I want to get a feel, so if you got to click this, to participate a little bit. Again, these are multiple choice questions that, as we said, would probably be something you'd see CPA exams. So let's look at number 5, and it says that there is a $10,000 sale, terms of 115, net 30. The company uses the gross method. What would be included in the journal entry? This is a 1-minute question. So this is kind of split. Actually, the class is kind of split in half, actually, on this one. The answer would be, if it's the gross method, how much do you record? Sale is $10,000, so you would have a debit to accounts receivable and a credit to sales for $10,000. So credit sales revenue shows up at C. All right, so the answer would be C. All right, so now let me, and the reason why I do this again, it doesn't count towards your grade, but it's important for us to know what you were thinking on that. So, one more question for you. What would you do if I said that the company used the net method? I'm not talking about the entry here, I'm not talking about this question, but what would the journal entry look like? So now I'm changing this, so you kind of get an idea what my exams look like. So this is a part 2 question for a open-ended, as you call them. We call them problems on the CPA exam, they're called simulations.
You will credit 9,900.
Not right, 9,900. So it would be, if this was the gross method, you got to debit to accounts receivable, credit sales for 10. If this was the net method, $9,900 because the discount is $100. But now, of course, if you look at question 6, it's the same question, but they changed the name of the company. And in this case, we got the answer right here. Now, if it's 110 net 30 on a $10,000 sale, you can debit accounts receivable and credit sales. Yeah, sort of like an exercise with this. What I want to do is I want to see if I use the gross method. That's question 5. And let's say question 6, we use the net method. All right, so the first part of this would be what entry would you make? I'm not saying this is going to be an exam question, but why not? All right, so now you collect within the discount period. Everybody? So what do you collect? How much cash? And same question is a 1% discount. So how much cash would you collect? 99, yeah. So you debit cash 99, and of course you debit cash for 99 as well. How much is the receivable on the books? If I use the gross method, what's the receivable look like?
10,000.
10,000. Right, so I'm taking the receivables off my books at 10. And therefore, I've got a sales discount for the gross method. Net method, what happens? What's the receivable look like? 99, so you do nothing. So I want to, again, using these two questions to pull it all together. Hopefully that's what we accomplish. All right, so now, let's collect after the discount period. Gross method, collected after the discount period. How much cash did you get? 10. How much receivable value? It's 10. So you got it all. No surprise. It's what expected. Now remember, these are, and what method is actually being used here? Most likely amount or expected value. This is the most likely amount. So you expected, the most likely amount that you expected was 10. You got 10, no surprise. However, the most likely amount in the net method was how much? 9,900. So you got cash that comes in at 10. A receivable is coming off at the most likely amount, which is 99. And now you've got more than you thought was most likely, and it is income. So you've got sales discount. It's understanding accounting for uncollectible amounts, or accounts, I should say. Using the allowance method, thinking about how to write off an account, and also, when we're done, understanding what recoveries would do and how they would be recorded. So the first thing we did in module number 1 was talk about the initial recognition. So what affects the initial recognition? So far, all we know are sales discounts, correct? Starting in chapter 8, intermediate 2, lots of other things could affect the initial recognition of the sale. As we said, the probabilities and bonuses and penalties that are built into contracts would be included. Then we want to talk about valuation, so that's this module. How do we value the receivables after acquisition? And then disposal, can you use receivables to get cash? Well, sure, you can sell receivables. A lot of you may have studied this in finance. During the financial crisis, we had lots of what was known as securitization, where companies would set up special entities to buy receivables, package them up, and use them as collateral for debt. And when those receivables went bad, the debt was worthless, and those companies collapsed. So we'll talk a little bit about that as well. But when you sell the receivables, it's known as factoring accounts receivable. So this is something you probably didn't see. Well, let's get to what you did see already. And we know what receivables are. What we want to do is talk about the valuation. Now, I'm going to tell you that we don't use the time value of money. We may come back to this, or we already talked about the discounts, we talked about trade discounts and cash discounts. We may get a chance to look at, we're definitely going to see that in intermediate 2, but we may get a chance to look at the idea that if a receivable is more than 1 year in length, you may have to use discounted cash flow that you see in finance. If not, we would have it at its face value. What we really want to talk about here is the valuation and the probability of bad debt. Everyone understands that it's likely that you will not collect all of your sales. And the two methods to account for bad debts, you may not have seen direct write-off. I'm just going to mention it briefly. It's a tax method. And then we also have the allowance method, which you've seen, the allowance for uncollectible accounts. On the direct write-off method, it is a tax-based method because you only recognize the bad debt in the year in which it is uncollectible, not in the year of the sale. So if you remember back in the material for the first exam, we talked a lot about direct association, correct? The bad debts should be directly associated with sales, but the direct write-off does not do that. So let's say that we had this sale. Let me just use the same information that I have here just for purposes of illustration. And let's say that this sale was in 2018, and in 2019, $2,000 becomes uncollectible. On the direct write-off, you would directly write off the receivable. You would debit the bad debt expense. Let's say it's $2,000, and you would credit accounts receivable for a specific customer. So the direct write-off would mean you'd have to wait until, especially for tax purposes, the internal revenue is not going to allow you to say in 2018, well, you know what, I got 10,000 in sales, I think that I'm not going to collect 3,000. So I'm only going to report 7,000 in income. They're not going to allow you to do that. You have to have the bad debt actually occur. And when it occurs, you would debit the bad debt expense, and the customer account would be written off. Now, here's the problem with that. The problem is, number one, in the year of the sale, Are we overstating income? That's the question we have to ask. Do we overstate income? Right, yes. We overstate income because we did not properly provide for the potential uncollectible accounts. So number one, income is misstated by the direct write-off method. The second problem is that accounts receivable are overstated. Accounts receivable should be valued at what we call net realizable value or cash realizable value. That's the amount we expect to collect. So the problems with direct write-off is that it would, number one, not properly measure revenue, and it would not properly measure the receivable. And that's why we use the allowance method. So the direct write-off approach is a tax approach. So we use this primarily for tax. Now, would you ever see this? Would you ever see it in practice or in business? Maybe, if it's immaterial or insignificant. If not, you'd have to use the allowance. So, under the allowance method, in the year of the sale, in 2018, say the accounts receivable and sales again. And that was sort of step number one, the initial value. I didn't take the discount, I could have valued that, I could have valued that using the expected value. Here I'm using the gross method. I have to come up with the estimated bad debt. So let's say we estimate that 3,000. So we estimate that 3,000 would be uncollectible. What's the entry? The entry is a debit to bad debt expense, and we credit the allowance for bad debts or the allowance for uncollectible accounts. And that is done in the year of the sale. That is done in the year of the sale. At the end of the, this is, let's say it's today's date. This would be December 31st, adjusting entry. Now, two reasons for this. This is all in the notes, but I want you to see it visually. Number one, the first purpose is that this expense is matched or directly associated with that revenue. And again, this is in 2018, or direct association. That's the first benefit. So it properly measures the revenue and properly measures the expenses. Then at the same time, at the cash or the net realizable value. The cash or net realizable value in this case is $7,000. So that will properly value receivables at the minimum amount that you expect to collect in cash. That's the amount that you expect to collect in cash.
When do I determine that? Like, do I do it at the point of sale?
No, you do it at the end of the year. At the end of the year. You make an estimate. By the way, why do we use an allowance account? Because we don't know what accounts for sure are going to go bad. So it's an estimate. So the allowance is a contra asset, right? So the allowance is a contra asset account.
Is allowance a temporary account?
1 second. Contra asset. Let's get that. It's a contra asset, so it offsets on the balance sheet. So you're going to show $7,000 on the balance sheet net. It's almost like accumulated depreciation, which is an estimate. And that's why you use accumulated against all the assets. Here you use allowance against all the receivables. So I don't know if your account, I don't know if my account is going to be uncollectible, but I know that some accounts, based on experience, we'll talk about the estimation techniques in a second, got to come up with something. How do I come up with it? It could be based on past experience. It could be based on, well, we're talking about aging, the percentage of sales, whatever it is, we come up with those numbers. And the point is that you've got two important objectives here, because you've got an income statement objective, which you see here, which is the matching. And down here, with the contra asset, you've got a balance sheet objective. So the goal of using the allowance method is to make sure the receivables are properly valued and to make sure that net income is properly stated.
I don't get how there's a direct association in the allowance method between sales and bad debt expense, but
Right.
not direct write-off.
Because there are several methods that base the bad debt expense on sales levels. So the higher the sales level, the greater the expectation of bad debts.
Well, why does direct write-off also have a association?
Because the direct write-off is writing that off a year later. So the sales in 2019 are being penalized for that expense, not the sales in 2018.
So the main difference happens a year later is.
Yeah, it's timing. It's timing. Oh, the other difference too is that you don't meet the objectives. From the standpoint of proper accounting standards, the receivable is overstated and revenue is overstated in the year of the sale. That's the main problem. The other rationale, which we're going to get to when we bring it in now, where does that direct association come in? If you didn't offer credit, how would your sales be affected? Go to any retail outlet in the city, go across the street, anywhere. What happens? You walk in, sorry, we don't accept credit. What happens? What happens to their sales? They go down. Offering credit increases sales. Therefore, the cost of selling on credit should be matched with the increased sales. So if sales are going up, you sell on credit, your revenue is expanded, therefore the cost of selling on credit needs to be recognized. And the cost of selling on credit is the bad debt. So that's the theoretical explanation for that. Higher sales revenue are generated because you offer credit. And therefore the cost of selling on credit needs to be directly associated with those sales. Another example are warranties. What if you have a product and you don't offer a warranty? Somebody next door offers the warranty. Look at, when you shop vehicles, right? You might notice that a lot of car dealers are in a row. You could walk from one to the other. Comparison shopping, that's why they do that. You go into one dealer, they have no warranty. Or you go to the Hyundai dealer, so they're going to give you 10 years. Audi gives me 4, or Ford gives me 3, or GM gives me 3 years. Now think about it. So the warranty is a way to increase sales, and therefore, what do you think you do in the year of the sale? You estimate the warranty cost in the year of the sale, not when the car comes back to be repaired. Same logic. And what you're going to find in accounting, there are a handful of theories that keep popping up, and somehow you'll be able to use them if you ever run into something that's unfamiliar. And that's the point of accounting training, to get you to understand the underlying principles and use them when you are faced with an unfamiliar transaction. So the matching or the direct association is the income statement objective. Proper balance sheet valuation is the balance sheet objective. Now, we're going to take a look at estimation techniques, and you're going to find out this entry has to balance. So the more emphasis you put on the expense, the more it's going to reduce the receivables. The more you put on the allowance, the greater the expense. But which one do you want to focus on? So we're going to find out that there are balance sheet estimation techniques and there are income statement estimation techniques. It's a trade-off. Some want more expense that makes the receivable lower than maybe it should be. Some want the receivable properly valued. That may not get you the expense you want. You trade off. That entry's got to balance.
So after you make the the allowances for capital expense? How do you close out that account at the end of the year?
At the end of the year, that would stay as is. If you write something off, we'll show you, you write it off against the allowance. No other expenses. So if this customer, let's say in 2019, and you don't need to copy this because we're going to show you a full example. In this case, if an account is actually written off, you debit the allowance. And you credit accounts receivable. So you write off an account here as the customer. So to answer your question, the allowance account becomes a cushion. Sometimes they call it a reserve. That's where you write your accounts off. No more expenses, you already took the expense. Information you have during the year is that we started off with no receivables. We've got credit sales of 12 or 1.2 million. We've collected 895, and we have accounts receivable at the end of the year of 305. The allowance for bad debts, the unadjusted amount from the prior year is 4,000. So I'm telling you that there is an existing, the most important piece of information here, one of the most important is that there's an existing credit balance of 4,000. So here's the way the T accounts look. You've got no beginning balance, you got sales of 1.2, you collected 895, your ending balance is 305. Bad debt sitting there at 4,000. So the cash realizable value or the net realizable value in this case, we need before I should say 305 before, cash realizable value is 301. Okay, cash realizable value is 301. Now, we have different methods of estimation. And remember our objectives. How do we estimate the bad debt for this year? These are not necessarily what a company is going to use. This is more of a starting point, maybe a textbook construct, but we've got income statement methods. So, when we look at the approaches, and I've got the table at the end of the module, so you can go back and refer to it, but the income statement method is the percentage of credit sales. So the focus is on the income statement, the matching, and it forces or trade off is in the net realizable value. So the idea is with the income statement method, the main goal is to get the expense at a certain level, and that will force the allowance and the net realizable value. The balance sheet approaches, percentage of receivables or aging, the focus is on this is the proper income statement matching. You want to properly value the receivables, your net realizable value. So your focus is on the allowance account. And you force or trade off the expense. So percentage of credit sales has an income statement focus. Bad debt focus is the expense. Percentage of receivables, aging, focuses on the allowance for bad debt. Right, that's what you want. The allowance to be at a certain level. You want the net realizable value to be at a certain level. And that is going to be the emphasis. What gets traded off the expense. Right, so again, remember, this entry's got a balance. So the amount you put in here will affect the expense and vice versa. When you put the expense will affect the allowance. So let's see how it works. Right now you're looking at a theoretical set of information. So let's see how it works. And by the way, these are sales and credit that's granted by the company to their customers. These are not plastic sales. You should know that debit and credit card sales are counted as what? Cash. So if you have a business and you accept credit cards, cash. You don't have a receivable for that. That's not your problem. Citibank or whatever, whoever has the Visa or MasterCard that you use, Wells Fargo, they gotta wait for the money, right? But the vendor gets their cash. For 2%, we take it off, whatever the discount is. All right, so let's now use an income statement approach, the percentage of credit sales. So our sample company believes that 2% of credit sales will become uncollectible. So you take, there are credit sales of 1.2 million, which there were this year. You take 2% of that. You're matching or directly associating the $24,000 of bad debt expense with the revenue, and you credit the allowance. The focus is on the expense. So again, you don't have to copy this down. I just want to give you the visual. You'll see the T accounts in a second. But again, you're going to debit the bad debt expense. You're going to credit the allowance for 24. What happens here, when you credit the allowance for 24, I'll put this up on the screen in a second, the allowance account balance goes to 28, and therefore the net realizable value, the cash realizable value, is going to be 277. So your emphasis was on the expense. You forced the allowance to be 28, and you forced the net realizable value. So that if you look at the T accounts, that balance is a byproduct of that engine. Understand that, ask yourself the question, what would have happened if the beginning balance was 10,000? Then the allowance would have been 38. What if the beginning balance was 0? The allowance would have been 24. So you don't really care about the allowance as much as you're concerned with the expense. That's the point of this approach. The income statement approach is focusing on the expense, and it gives up the valuation. When you get a valuation, what is it the valuation you want? Let's do another one. Then I'll ask you a question. What if we switch now to a balance sheet approach? And we say, let's do an aging of accounts receivable. I'll show you what that means, but you might have seen this before. Next time you or someone in your house gets a dental bill, look on the bottom of the bill. And it's going to say current, 30 days, 60, 90, that's how many days past due. The bill is yours, will probably be current, you just went. We look at those receivables and we age them. And we look at the balance. So what we would do is ask the client to give us a run of all their receivables. We would categorize them by age. And then within each aging category, we would say, all right, we'll make 1% of current receivables an estimated bad debt. 6% 30-day overdue, whatever it is, we then get an estimate. So I'll show you that in a second. But what if I told you that estimate is 25.5? Here's the problem with the balance sheet methods. It's an extremely important point that we need you to really zoom in on right now. If you're given a balance sheet method, you have to look at the existing balance in the allowance for bad debts, because that will drive the expense. So what if I told you that we need a balance of 25.5, and what if the balance in there was already 25.5? How much expense would you have? Nothing, right? So you'd have nothing. That's the point. So in this case, you got a credit balance of 24, and here's a very important calculation. You look at your target balance, you would add a debit balance. So if there's a debit balance in there, you got to remove it first, and then bring in the new balance of 25.5. In this case, you don't have a debit balance, you've got an existing credit balance, so the expense or the adjustment you need is 21.5. In other words, and you will see this, you don't have to copy it, but if my target, and you don't necessarily need that formula, you could use a T account. If my target is 25.5, again, like I always say, accounting gymnastics, you got to start plugging in T accounts here. What's the missing number, right? It's going to be 21.5. Now, the problem is, that's the number you need to get the allowance you want. You really wanted an expense of 24 if you were going to focus solely on matching, but you don't. You get 21.5. So the bad debt expense is debited for 21.5, the allowance is correct. Yeah.
The 25,500 is given to us, right?
That would be given, or it's got to come from an aging schedule, which I'll show you. You may have to calculate it. It's not a matter of taking percentages.
How many months in do they go, like 4 months tops?
No, they go out, let's see. Yeah, typically 120 past due. 120 days past due. It's about 4 months.
So I have to do none, 30 days, 60 days,
9
90
days
days,
for 120, typically. And my clients usually return the accounts over to collection attorney after 120.
After one.
After 120. Yeah, depending on the client. So a lot of clients, some of them would pull the trigger on 90 days. If you were 90 days overdue, 3 months, they would send the receivable out. If not, sometimes they work with you. So they would say, all right, well, and sometimes they make you take a note. So if you're not going to pay me on a receivable, now you're going to sign a formal note with interest, you know, whatever they think they can do. But it's usually 120 over, it's a complete write-off. And we would also do specific reviews of accounts. So we would go down the client's aging schedule, and we find a couple of, 120 overdue, maybe 90, and we would go out to them and actually analyze their financials as well to see what the possibilities of payment. The other thing you might do, I don't know if you ever, one of the things you're not going to like in public accounting are confirmations. So if you're working on a company that is doing receivables, when you get there, you may have to stuff envelopes. And they send confirmations. Sometimes they send emails. But you usually get in the mail that, Wells Fargo is being audited by KPMG or Wells Fargo. According to their records, this is your balance in your certificate of deposit. Please confirm. And based on that, you don't get a lot of them back. But based on that, we would determine the collectability of those receivables. Usually in a business setting, you would send it to your major suppliers, for example. You were a major supplier, your major customers, and you'd send it to them. So now the point is that you have forced the expense to get the allowance that you want. So the proper valuation is on the allowance for bad debts and the net realizable value. So those are the two methods. Now, Terry had a question about a write-off. When you write off a receivable, no further expense is incurred. So the write-off entry goes against the allowance. Now the allowance account, as we said, is like a cushion. It's a reserve against which the allowance or the bad debts would be written off. So any write-off under the allowance method does not generate additional expenses. So you debit the allowance account, credit the accounts receivable for the specific customer name. So it does not generate additional expense. And remember what we said, this could be 2 years later that you write this account off. You don't want to distort net income in that year. So if this sale was a 2016 sale and you write it off in 2018, no additional expense is charged. And the important point to note, this is always, I know you saw this in intro, but the write-off never affects the net realizable value. So the write-off reduces receivables by 25, and it reduces the allowance by 25,000. So the accounts receivable would be down by 25,000. So it's got a balance of 280, and bad debts go down to 5. The net realizable value is 277, and that's what it was prior to the write-off. So if you look at the numbers we had before, 277.5, I should say, we go back. So they, 279.5. So if you go back to the original net realizable value, it's 279.5 before the write-off. After the write-off, it's exactly the same. So write-offs do not affect the net realizable value of accounts receivable. Under the allowance method. So any questions on that so far?
The write-off, it doesn't increase my cash?
No, doesn't, basically, this would have no effect at all on cash flow because it doesn't change the balance of your assets. The reason for it is that you've already provided for that loss. And when it happens, it doesn't change anything. So you've already provided for that loss, and when it occurs, it does not change anything. So you have no decrease in your total assets. So net realizable value, 279.5 before and after the write. Just one more point, and that is, what about a recovery? What if there's a recovery under the allowance method? I'm going to tell you that under IFRS, recoveries go back into income, but under US GAAP, recoveries require 2 steps. The first step is that you would reinstate the account, and you would restore the credit rating of that customer, so that if of those accounts we wrote off, so we just wrote off 25,000 of accounts. Right, so here was the write-off. So we just wrote off 25,000. If you recover, first step, reinstate the account, it reverses the write-off, correct? It debits the receivable with the customer's name and credits the allowance. Then you record the collection. So a 2-step process. If there was a recovery, so if I told you, yeah, you wrote off 25,000, and 6 months later, a customer with a balance of 1,200 pays you back. You first reinstate the account, you put the allowance back. Why? You don't need to use that allowance anymore, right? I mean, you now restored the allowance, you now have more of a reserve. So you debit the receivable and restore the customer's credit, and then you also credit the allowance for uncollectible accounts. Then you record the collection as you would in a normal